So we are in episode 37 of the continuing series of the ICT Mentorship for YouTube 2022. Here's our daily chart for the E-mini S&P June contract for 2020. And you can see we have worked inside this fair value gap. This is also a breaker. Okay, breaker is a low, high, lower low. Find the high in between, extend it out in time. The market trades down into that. It's also coming down in to fill in this fair value gap. So we came down, fill that in, and now we're starting to rally. Next buy side liquidity is this short-term high here. And then if we can get some acceleration on the upside, we have relative equal highs up here in that fair value gap. Okay, so for the students here that are looking for a little bit more meat on the bone for bias, okay, when the market is moved from a low like this and starts to trade higher and creates a swing low, it's easy to assume that it might want to come back up to this high here. So notice how each day, with the exception of this one single day here, each day was bullish. Okay, so the bias would be expected to be bullish until we take out this high. It does that here. Then we have a day or two of retracement, which is logical because we created a fair value gap here. It trades down, fills it in once more, tests it, and rallies. So we're looking for tomorrow, which is Friday. Non-farm payroll is a day I do not advise anyone to actually try to speculate on. So bias is going to be derived from this chart here. Because we're likely to run this short-term high, that's what I'm thinking, I'm expecting that. It could happen overnight. There's nothing saying it's going to wait until tomorrow at 8:30 when non-farm payroll comes out. But if it doesn't run out this high tonight, at 8:30, if we're above the fair value gap high here, in other words, the candlestick's low here, if we're above that level at 8:30 and we have not taken out that high, I would expect price to try to make an attempt to get to that level. It doesn't need to go through it. But the bias would be, I would expect that to be attempted. Okay. Now, does that mean go out and try to trade non-farm payroll tomorrow? No. A lot can happen from the time of this recording, which is a little bit before 9 o'clock Eastern time in the United States. So I'm not trying to trade non-farm payroll. Okay. I'm not instigating any interest for you to go out and do it tomorrow. But I do believe that you should study it. Try to determine what side of liquidity is going to reach for before 8:30 news release. And when that volatility hits the marketplace, watch and see what it does on like a 1 and 5 minute chart. Get a feel for what it's doing. And it's an amazing study for liquidity purposes only. But unfortunately, sometimes these moves can appear, well, to the untrained eye, random. And then to the initiated here, sometimes the patterns that I'm teaching you and the logic materialize in the chart. And sometimes they do pan out to script, but not always. So the reason why I tell everyone to avoid like big days like FOMC and non-farm payroll weeks is because you don't have the experience and you can get hurt very quickly not knowing what you're doing. So be mindful of these levels here, the two blue lines here and that red line here. It's a little bit lighter than these. You won't see these on a lower time frame, but this here is that short-term high here. And the two blue lines here are respective to that fair value gap on the daily chart. All right, hourly chart, E-mini S&P. Market trades down to the discount low of the fair value gap. Again, these levels here are not drawn because of the basis of support and resistance on an hourly chart. Okay, these are the same levels that I drew on the daily, and when I change time frames from daily to hourly, they transpose to these levels here respectively. Okay, so the market trades down on Wednesday, hits the fair value gap low, then we consolidate, and then we drop one more time to it here, then we make a mad dash to take out the short-term high here. We have a shift in market structure that's bullish. We take out this short-term high here and relative equal highs. And now we're gravitating towards what looks like a run on the buy side here. Now, it does not need to do that tomorrow. I could be wrong about that. I'm just saying that I think that this is the next draw on liquidity, so study that. That's all. Now, we do have a small little fair value gap in here. Be mindful of that. It might want to drop down into that before going up there. That's certainly something to study also. All right, on the 15-minute time frame, you can see here, this is the markup for the short-term high here on Wednesday's trading. We hit the fair value gap low on the daily chart. Went back, hung around in consolidation, rallied up. And I was in here trying to get a feel for what it wanted to do. I was thinking that I could capture a run to take the buy side out here. That's what I was aiming for initially, really early in the session. And this got chopped up a lot in here. And it's fine. I really don't care about that. But once I realized it wasn't trying to rally, and they were going to try to take it once more below the New York midnight opening, which is this candle here, I want you to take a look at the way this day formed before I get into any more discussion about it. We opened here, consolidated, rallied up, and then dropped down into the fair value gap low on the daily chart and bounced there, rallied up, took out the short-term high here, and then kept on rallying and then closed here. This formation of price action is what I dub my ICT Power 3, where it's accumulating, manipulating, distributing. So it's opening, create the low of the day, and then rally. Now, if you see this pattern on a daily chart, it's easy to understand, but when you look at the lower time frames, it's easy to get lost in all the candlesticks and all the volatility and the movement and the quick fluctuations on these 1 minute and 5 minute charts. That's why the uninitiated would look at it and say it's noise. It's not noise. Okay, it's doing what it does on the daily chart, just being represented on a smaller interval, like a 1 or 5 minute chart. So if you lose the context of, like, for instance, the levels here and here, you won't understand that it's dropping down to that higher time frame key level, which is the fair value gap low. Then the market can rally higher. The afternoon, that setup, I want to go into that a little bit. So my expectation was we were here and we were likely to draw up into that in the PM session. So in other words, as we were going into lunch and on the other side of the lunch, we could have easily traded up into this area as an upside objective. And then I didn't mention it, but you obviously know if we get above that, what will be the next logical draw on liquidity? It would be above this high here. Okay. Now notice what we have here. We have a short-term low here during the New York lunch hour. We're consolidating. The market drops back down and takes out that short-term low. We have unfinished business above that old high here. This is a stop run here, and it just slowly drifts up and takes that old high out. The only setup I liked was obviously the short and the re-entry in addition to the short I did, and you can see that on the vignette that I posted on Twitter. So I'm not going to bog the video down here with that. It's already made public. The afternoon session, or after the low was formed, notice there's no model entry for what I've taught you so far, but we have a nice fair value gap with the continuation to the upside with the fair value gap I was pointing out real time before it happened.